Welcome back to Switzer on Australia's Business Channel. Former CommSec Chairman and CEO Paul Rickard has become our official road tester of market stuff, which many of us haven't got the qualifications to analyse ourselves. And tonight we look at two growth areas, ETFs and listed investment companies, all linked. So which ones are the best? Paul, how do you like being our road test guy?
Thanks, Peter. Look, it's great to be christened something.
Why don't you just don't start bashing producers and carrying on like other Top Gear road testers? Now, mate,
I thought you were going to call me Top Gear Paul or something. They'll
come.
Oh, okay.
You got to earn that stripe. All right, Paul. For people who aren't quite sure, quickly, ETFs. What are they?
Okay, exchange-traded funds. They're listed on the stock exchange, and really a really easy way to get access to the market. They essentially are almost investments on autopilot, Peter, because they passively track an index. So we've got sort of three major exchange-traded funds that sort of track the broader market. And in each case, they're a low-cost way to invest, and you're sort of pretty well guaranteed to get index performance less a fraction.
Okay, we've got a chart coming up. So basically, this chart will actually show how these have performed over 1, 3 year. No, wrong one.
Well, I think we just got the first chart, which just shows you the three I was talking about.
Yeah.
So IOZ from iShares, it passively tracks the MSCI 200 index. You've got STW from SPDR that follows the S&P ASX.
The Spider,
200.
right?
Yep,
Yeah.
Spider, which is the largest. And the Vanguard VAS, which passively tracks the S&P ASX 300.
Yeah.
So with each of those, if, for example, the ASX 200 goes up 10% during the year, you can pretty well guarantee your return's going to be 10% less a fraction.
Okay, the next table basically shows that as well. And I'm curious about these, Paul, in particular the fact that the Vanguard one, they're going to talk about listed investment companies first. All right, so we'll get to that in a second. Let's focus on listed investment companies next, and we'll do it side by side. Yep. So these are the biggies in the market.
There are 30 or 40 listed investment companies out in the market, and there are a lot that follow sort of smaller companies and some that are sort of what I'd describe as high alpha type listed investment companies. Yeah. These are the big ones that have been around in many cases for a long, long time. Argo's been going since 1958.
God. Yeah.
And they basically follow pretty what I've described as a broad-based portfolio of shares. So very much an emphasis around blue chip companies. They invest in blue chip companies. Yeah. Companies that have got a really good history of paying dividends, making profits, all have slightly different investment themes. Now, the difference with a listed investment company compared to an ETF, these are actively managed. So in these cases, you actually have a manager. This is the company itself. These guys who are running these companies are actually managing your money and also working out how they're going to invest. And over the long term, they've all had pretty impressive investment.
How actively are they managed? Because they do take a pretty long-term and often contrarian position with good quality companies, don't they?
Yeah, look, they don't buy stocks and throw them out. They don't trade, but they're long-term investors. And each of those three funds has got a fairly specific investment mandate. And they're taking a 5 to 10 year approach in how they look at companies. So, look, they buy and they hold. I mean, they do occasionally sell, but not very often. Yep. And they're obviously looking for companies that generally meet a specific mandate around dividend yield, some type of consistency in earnings, and also being relatively cheap. So if you actually look at their portfolios, they do tend to look a little bit like the top 20. Yeah. But they're a bit broader than that.
Okay, well, let's go back to the ETFs now, because I don't know if we've got a chart for this one here, but you certainly, in an article you wrote for the Switzer Super Report, you actually pointed out that Vanguard looks at the ASX 300, and that was a point you made. They're also cheaper.
So the thing about when looking at the exchange-traded funds, there's probably a couple of things to look at. One is it the right index?
Yep.
So although you might say there's not a lot of difference between an S&P ASX 200 versus the S&P ASX 300, obviously the 300's got 100 smaller companies at the bottom.
Yeah, and I'm going to ask you that because I think smaller companies have a good outlook.
Yeah. Over the last 3 or 4 years, the smaller companies haven't done very well.
That's right.
So the S&P ASX 200 has returned better than the S&P ASX 300. So in that case, SPDR's return over the last 3 or 4 years has been better than Vanguard's.
At a slightly higher cost.
At a slightly higher cost.
I think you got here that SPDR is 0.29% and Vanguard is 0.15%.
Yeah. So Vanguard's is the lowest cost of the ETF managers.
Yeah.
And so if I was looking for an ETF at the moment, because I'm a bit like you, Peter, I think that it's overdue for some
time for smaller caps.
Smaller cap to look at.
Yeah.
The two things I'd be looking at is what's the management fee,
Yeah.
and Vanguard's the cheapest on the management fee, and secondly, is it the right index? I would be investing in the Vanguard ETF, which is stock code VAS, because lower management costs, and also I think that's a better index.
Yeah, and the Vanguard guys are going to love us for actually saying...
Vanguard guys are going to love us. Send us a huge check, we hope, Peter.
No, just joking. All right, now, let's get into the area of comparisons because, OK, let's just say you're in the SPDR, you're tracking the ASX 200, you've done pretty well. Your 5-year average was, 8?
Okay. So let's go to the listed investment companies.
Yeah.
Unfortunately, I didn't put the chart of what the different returns are, but by and large, what you notice of the listed investment companies, those three we mentioned, Australian Foundation, Argo and Milton Corporation, is over the sort of 3, 5 and 10-year periods, they've largely outperformed the index by a little bit.
Yeah. So ETF is underperforming
ETF,
because of the cost?
Guaranteed to underperform, but only by a fraction.
Yeah.
The listed investment companies, of course, there's no guarantee.
Yeah.
But because of their very low management costs and their expertise in building portfolios and running a portfolio, they've marginally outperformed.
OK. Now, our team has put the chart a little bit too early, but the bottom line is this is a very interesting thing. I think a lot of our viewers don't understand when it comes to LICs, this concept of premium and discount is very important. Explain why, Paul.
So look, with an exchange-traded fund, let's go back to almost first principles.
Yeah.
You can pretty well be guaranteed it's trading at what we call the NTA, or the net tangible asset value.
Yeah.
NTA.
Minus the fee.
Yeah, minus the fee. And the reason for that is that they appoint a series of market makers.
Yeah.
Because they're on autopilot following an index, they're really easy to replicate.
Yeah.
And also hedge. So one of the brokers or whoever it is making the market, that's where the units are bought and sold, can almost guarantee to be within a fraction of their underlying value. So when you're investing in an ETF, you go to the stock market, you're basically paying NTA less or minus a fraction, but the fraction is tiny.
Yeah.
With a listed investment company, which of course aren't following an index, they've got someone managing them. The price at which they trade for on the ASX can be quite different to what they're worth. And they're simply because, A, people are less informed. There's not necessarily someone making a two-way market on the stock exchange, and they're not easy to necessarily replicate.
Well, can I throw an example? This is the way I've often thought of it. If, for example, if you looked at the total value of the stocks held inside this listed investment company, there would be a calculatable value. It might be, say, $2.
Yep.
But if everyone thought this is a really hot lick and I want to be in this lick, the stock market could bid it up to $2.20.
Could indeed.
That's a premium, isn't it?
That's a premium of 10%.
So the market value is actually greater than the intrinsic value of the company.
Yeah, people are paying more than what the thing theoretically is worth.
Because they believe this thing is going to shoot the lights out and they won't get in early.
Or just because of whatever it is, circumstances. And what you find, Peter, this is where we come to this third
bring the chart up now, guys.
Is that historically, LICs tend to trade some years at premiums, sometimes in discounts. So this looks at the last 5 years. Okay, for AFIC. AFIC, which is Australian Foundation, that's the largest of those companies I was talking about.
And it's currently looking at that one. It's
basically almost line ball marginal discount.
So if our viewers can see that two little bars at the end underneath the zero line, that means AFIC is now at a discount.
That's right.
So if you like LICs, you go out and buy AFIC tomorrow.
That's right. So just to show you that chart, that goes for 5 years, but you can see it's been as high as a premium of almost 15% and a discount of almost 10%.
Yeah.
So you've actually got when you're investing in a listed investment company, because you're buying it on the stock market, you need to look at what you're paying for it on market to buy it versus what it's actually theoretically worth.
So you're the kind of guy, I know your attitude, you always like buying cheap and selling expensive. You're funny like that, Paul. So if you liked AFIC, you'd like to rush in when they're at a big discount, like we saw when it was way below the zero line.
That's right, and preferably just, not always the case, Peter, but they tend to trade more at a premium in a strong bull market and a discount in a bit of a bear market. And that tells you a little bit about investor behaviour. At the moment, they're actually, all three of the ones I mentioned, AFIC, Milton Corporation, Argo, are basically line ball. So they're actually, on paper, a pretty good time to invest in those listed investment companies.
Yeah, and is there a good history that once they go into premium area, it tends to track up in premium for a while, or can go up and down pretty quickly?
It tends to be, as that graph shows you, they tend to stay there for, it's almost if the market's really bullish, they stay in premium. If the market's bearish, they stay at a discount. But over time, of course, people get better informed and these things do come out.
Okay.
So you can actually work out what the NTA is. So first of all, both exchange-traded funds and listed investment companies are required to publish their NTA. And they make, in the case of listed investment companies, they do it within 5 days at the end of the month. ETFs actually publish it in real time. If you go to most of the sites, for example, you look at iShares site, they've actually give you a real-time indicative NTA. And the listed investment companies are getting better. But you can calculate these things as well, because you just sort of take what it was at the end of the month, look at what the market's done. You know they're basically tracking the market pretty closely with a little bit of variation, and you can recalculate it.
Quickly, when do you buy ETFs? When do you buy LICs?
Okay, you buy ETFs when the LICs are trading at a premium. More than 2 or 3%, I'd buy an ETF. When the major LICs are trading at a discount or just a fraction of a premium, I'd invest in the major listed investment company. So at the moment, if you want broad-based exposure, you like to look at the market, I'd buy listed investment companies over an ETF.
Okay, one last thing. When a crash happens, do LICs fall faster because there's that that panic running for the exits? And my next question is that a great time to buy them?
And that's the time to buy them, and that's possibly why you see how they move from premium to discount. Because theoretically they should go down about the same as the market. There'll be a little bit difference because they're being managed actively. But often in bear markets, people won't touch anything, and they, there's willing sellers come in and the buyers aren't there, and that's a great buying opportunity. So, and that sort of explains how that sort of changes over time.
Okay, that's a nice summary, Paul. Well done. Okay, so if anyone wants to see that in writing, Paul's knocked that up for the Switzer Super Report. You can go to that website, Switzer Super Report. Coming up, we'll look at the pros and cons of parents helping their children get into their first home.